Hi, I'm Michael Ruger. I'm the managing partner at Greenbush Financial Group. Today we'll be covering backdoor contributions to Roth IRAs. This is becoming a more popular wealth building strategy because if you make too much money, you can't contribute directly to a Roth IRA. But planners have found a way to make these backdoor contributions using a conversion method to get money into a Roth IRA anyway. So today I'm going to be walking you through the steps. I'm going to be walking you through how to avoid some of the pitfalls we see people make when actually trying to go through this process. And here they are. First, let's talk about the income limitations for these Roth IRA contributions. So if you're a single tax filer and you make over $124,000 in 2020, you start to phase out of your Roth IRA contributions. If you're a married filing joint, you start to phase out of the ability to make Roth contributions at about $196,000. And those amounts change a little bit each year. But even though you can't contribute directly to a Roth, there are things called conversions, which there's no income limit to conversions. That actually got removed a number of years ago. There used to be, but not anymore. And a conversion is when I move money from a pre-tax retirement account like a traditional IRA directly over to a Roth IRA. There's no stop in between. Everything converts over. That's part of this Roth IRA backdoor Roth conversion strategy. Here's how the strategy works. If I make too much to contribute directly to a Roth, I would make a contribution to a traditional IRA and not take a deduction for it. So in 2020, the limits for IRA contributions if I'm under 50 is $6,000. So I make a $6,000 contribution to my traditional IRA. I don't take a deduction for it. I wait a certain period of time and then I actually convert it over to a Roth IRA. So now that $6,000 is sitting in my Roth. So as you can see, instead of just going directly to Roth, I did one stopover, processed that $6,000 conversion, and now it's sitting in the Roth and it's getting that tax-free accumulation. And if I follow the rules, tax-free withdrawal of everything when I'm over 59 and a half. So essentially I got it to the same spot, but I use that conversion process because there's no income limits on conversions to get it there. Now, the other thing about conversions that you have to know about is if it's any type of pre-tax dollars that go from a traditional IRA over to a Roth as a part of a conversion, you have to pay tax on those, but you don't have to pay a 10% early withdrawal penalty. But in this case, I never took a deduction for that contributions. Those $6,000 I put in are not pre-tax. They're after-tax contributions to a traditional IRA, and then I moved them over to a Roth. So when I moved stuff over, it was already after-tax dollars, so there ended up being no tax consequence. Here is the largest pitfall individuals make when doing these Roth conversions. Because you're trying to take after-tax dollars in a traditional IRA and move them over to a Roth and just pay no tax in this conversion process, the IRS has an aggregation rule for conversions, which means you have to aggregate all of your pre-tax IRA sources together when they determine whether or not that conversion is taxable. So let me give you an example. So let's say you already have a rollover pre-tax IRA sitting out there with $95,000 in it, and you put $5,000 into the traditional IRA, don't take a deduction and want to process a conversion. When you process that conversion, it's not just, hey, put 5,000 in and I'm going to convert 5,000 over, no tax, and I've successfully funded my Roth IRA. They're going to say you put 5,000 into that traditional IRA, no deduction, but your total pre-tax assets are the 5,000 non-deductible plus the 95,000 you already had in your rollover IRA, which is pre-tax. So you really have 100,000 in these pre-tax sources. So look at the percentage. If you move 5,000 over of your total 100,000, that's 5%. That means when you do that conversion of $5,000 over to the Roth, 95% of that is going to be taxable to you. You don't get to just piece out the after-tax amount that you just contributed. So to make this Roth conversion or Roth backdoor contribution strategy work, you have to make sure you have no other pre-tax IRA assets. And that includes simple IRAs and SEP IRAs, which sometimes people overlook. They're still IRAs, even though they're within an employer-sponsored plan. So because it's the pre-tax IRAs that count, not necessarily 401ks, 403bs, if you have pre-tax IRAs that are sitting outside and you want to do this backdoor Roth conversion strategy, a lot of times we'll have clients roll their existing pre-tax IRAs into their 401k accounts or 403b accounts. That gets them off the table. Then they're free to do these Roth backdoor contributions without the tax ramification because they have no other pre-tax IRA assets. The rules don't care about your qualified plans, your 401k, 403 pre-tax. They just look at your pre-tax IRAs for purpose of this aggregation rule. The one other item that I want you to be aware of is something called the IRS step transaction rule. So the IRS has a rule that says if you sidestep and use legal methods to sidestep current tax laws, they can look through it and unwind it and say, nope, that was your intention from the beginning, you violated the tax law. So when we look at these backdoor Roth IRA contribution strategies, essentially you make too much, contribute to a Roth IRA, so you're sidestepping it by contributing to a traditional, then converting over to the Roth IRA. Timing could be key here. So we see individuals make the mistake that they contribute to the traditional and then literally the next day they convert it to a Roth. It's pretty tough to argue that that wasn't your intention from the beginning. So you may want to instead contribute to traditional, not take the deduction, and then wait 60, 90, 100 days and convert it over to a Roth. That might be a little bit easier to defend than just doing it all in one fell swoop. But the one thing to be aware of, that if you put money in a traditional IRA, and it's non-deductible, but over that 60, 90 days, it makes money. When you do the conversion, if you end up converting the whole thing, you will have to pay tax on whatever that's made from the time you made the non-deductible. You don't pay it on the basis because you never took a tax deduction for it, but the earnings piece will still be a taxable event. You have to report that as ordinary income when the conversion takes place. No 10% penalty because it's a Roth conversion, but just know you might have to pay some taxable income on that gain that accumulated in the account in the interim. I hope this was helpful. Feel free to reach out to us with any questions at moneysmartboard.com. Thank you.